Hello, everybody, and welcome to our webinar today to the Business Entity Choice in 199a Deduction discussion. My name is Matthew Latham. I'm a Senior Tax Manager here at Costerisan. We have spent quite a bit of time, especially recently, with the 199a regulations that just came out. So we're really looking forward to presenting this webinar, as well as a couple other webinars later on, which we'll get to towards the end of the presentation. The agenda, although it looks very, very short, actually is somewhat complex. First, we'll start out with just a business entity discussion, kind of in general, talking about the old tax law and some of the impacts of the new tax law has, whether you're a C-Corp, whether you're a pass-through entity, being an SCorp, partnership, or trust, or whether you are a single member LLC reporting all of your business income on Schedule C or Schedule E. Then we'll get into some of the Section 199a details, eligibility rules, and some of the general rules. I didn't want to get into specific calculations because I wanted to make sure everybody was awake by the end of the webinar. However, feel free to contact me if you would like specific examples showing the detailed 199a calc. And then at the very end, we'll kind of go back and connect back to the business entity discussion, talk about entity selections, as well as one or two other items related to the 199a deductions just to be aware of. So under the old tax law, this is through December 31st, 2017 year end, C corporations were taxed at a maximum 35% tax rate. It is a graduated rate, but it didn't take much to get up to 35%. In addition to that, you had a 6% corporate income tax rate you had to deal with. And on top of that, if you wanted to get the profits out of the entity, at some point you would have had to have paid individual income tax, whether it was in form of a wage or in this case as a dividend, where your capital gain rates varied from either 0% up to 20%, as well as potentially exposing yourself to a 3.8% net investment income tax and then the state income tax rate. So basically this meant that you could pay 41% at the corporate level and just over 28% at the individual level by taking the profits out of the corporation. S-Corps, basically you just dealt with the personal income tax rate. There was no corporate tax. There is no state corporate tax anymore, at least in the state of Michigan. Distributions, generally speaking, were tax-free. Potentially got a little more complex than that if you didn't have basis in the entity. And this basically put your highest tax rate at 43.85%, which under the old tax law was the 39% personal income tax rate plus the 4.25% state income tax rate. And then partnerships dealt with the same personal income tax rate, as well as potentially dealing with some self-employment taxes depending on what your involvement was, depending on how active you were in the entity. And then we also had single member LLCs, which basically are your Schedule C's and your Schedule E on your 1040, which once again, you basically just dealt with the individual tax rate, just like S-Corps and partnerships, may be subject to self-employment, mainly dealing with the Schedule C's there. And one potential drawback there compared to an S-Corp or a partnership in the case of a guaranteed payment is that you couldn't pay yourself as the owner a wage out of the entity, which does factor into the 199a calculation later. Single member LLCs, though, did have a choice. They could potentially make an election to be taxed as a corporation, and then on top of that, you could potentially make an additional election to be taxed as an S corporation. Under the new tax law that went into effect at the start of this year, the C-Corp rate dropped to 21%. For fiscal year filers, what this meant was that you have a blended rate, which basically you kind of take a weighted average. You figure out your tax rate under the old law for your entire fiscal year. You figure out your tax rate under the new law for the entire fiscal year, and then depending on how many months are under the old law versus under the new law, you took a weighted average, combined the two numbers, and that is going to be your new federal tax for at least your fiscal year ending 2018 before you're fully under the 21% rate. Calendar year filers, it was a little bit easier than that. It's under, at least through your 2017 tax return, you're under the old law. For 2018, you're under the new law. We'll get into this in a minute. Individual taxes, however, still do apply depending on what you want to do with the profits. All the pass-through entities, whether it was SCorp, partnership, whether it was Schedule C or E, dealing with a slightly lower max tax rate at 37% instead of 39.6, and you're also dealing with the 4 1/4 state income tax rate. So at least on the surface, a lot of people and a lot of what you probably heard on the news is that you look at this, and if you're an owner of an SCorp, you go, wow, why wouldn't I want to be a C-Corp? Or if you're a partnership, why wouldn't I want to try to make the change and become a C-Corp? Same thing with a Schedule C or E. I'd much rather pay 21% versus 37 plus another 4%. However, like everything in the tax world, it's not that easy, and there's actually a lot more to this. One big factor is what are you going to do with the profits in the C-Corp? Eventually, you have to get it out of the entity, which eventually will take away a lot of the tax quote advantages that you might see on the surface of being a C-Corp now. The other thing that Congress did is added the 199a deduction, which is the 20% pass-through deduction. The big reason for this is that C-Corps got such a huge tax break. They did want to do something for small businesses, provided that you qualify. And the idea is this was going to try to level the playing field and make it so that, at least in the eyes of Congress, there wasn't necessarily a big advantage going one way or the other, which, as you'll see, isn't necessarily the case. So in general, the 199a deduction is a 20% deduction of your domestic qualified business income from a partnership, S-Corp, sole proprietorship, or trust or estate. Basically, this drops your effective maximum individual rate on that income to 29.6%. All service industries are also included in the deduction, provided that your taxable income does not exceed a certain level. It's important to make that distinction when we get into at least some of the general calculations of the deduction. You'll see that once your income hits a certain point, there's limitations, and for service industries that are listed, those limitations mean that you don't get the deduction. However, if you're under the thresholds, then you still do get the deduction whether you're a service industry or not. So tax planning here could be very, very important. Those taxable income thresholds, which are determined at the 1040 level, if you file a joint return and your income or your taxable income is under $315,000, you get the full deduction. If you file under any other method, whether it's single, married filing separately, head of household, if you're under $157,500, you get the full deduction. And then there's a phase out period, which if you file a joint return, you're completely phased out at $415,000, or at least the limitations start if you hit that $415,000 threshold. And then for all others, it's $207,500. This is a reduction of taxable income for any manufacturers out there, construction companies. I find it helpful to kind of think of it like the DPAD, the domestic productivity deduction. It's not quite the same thing, but I do know that some of the regulation of 199 Cap A was actually taken from the DPAD regulations, which coincidentally was also was under Code Section 199. However, the DPAD is now gone. This 199A kind of replaces it. If you have no taxable income, you don't get a deduction, so you can't increase any losses. And if your taxable income gets too low, your deduction might be limited. So for example, if your taxable income ends up being, say, $20,000, but you had to calculate a deduction of $20,000, you're not going to get the full $20,000 deduction. And we have actually seen some draft 1040s that are out there. If you actually search for the 2018 1040, you'll see a very mini form, and you'll see that the deduction is on the second page just above the taxable income line after your itemized deductions on your 1040. So what is 199A? 199A defines a qualified trade or business as any trade or business other than a specified service business or the trade or business of performing services as an employee. Specifically, a specified service is any business activity involving the performance of services by employees or owners in all the fields listed there. Also, there's kind of a catch-all that any business where the principal asset of such business is the reputation or skill of one or more of its employees. And I know when this first came out, that last sentence, the last bullet point there, scared a lot of CPAs, because if you think about it, usually when you're going to somebody that provides a service, it's probably because of the reputation or skill. You generally don't just go to anybody. Somebody recommends somebody. A common example that we would talk about is that you go to a restaurant usually because you hear they have good food, so they have a good reputation. So a lot of CPAs were worried that this catch-all was basically going to throw out any service industry. What we'll find out here in a minute, though, is that when the IRS came out with regulations a couple weeks ago, the IRS actually narrowed the scope of that tax code because they saw the potential issue and they felt that they actually wanted more taxpayers to qualify for it than not. So basically, W-2 income that you pull from your business does not count towards the 199a deduction. So wages that shareholders from SCorp or guaranteed payments to partners are not considered qualified business income. What this means is that if you pay yourself a wage, that $100,000 W-2 doesn't get a 20% deduction. Now the expense is still included on the business return, so that it impacts what your QBI is, what your qualified business income is, but it just doesn't get the additional deduction. Also, I know we have a lot of clients that are involved in publicly traded partnerships. Surprisingly, the IRS has said that publicly traded partnerships may qualify. So if there's any ordinary income, basically non-investment income that comes through the publicly traded partnership, that actually would qualify for the deduction. The other biggie was real estate. Most people, when the law first came out, at least on the surface, felt that, I should say, some people felt that all real estate would qualify. Some people felt no real estate would qualify because it wouldn't make any sense since it's generally treated as a passive activity. The new regulations did very little to clarify this. So the thought now is that the IRS is going to have to come out with some changes or a new proposed reg to help clarify it. Generally speaking, since real estate isn't considered a trade or business, that's kind of why some people thought it wouldn't qualify at all. However, we do know, especially if you're a real estate professional, it actually does rise to the level of a trade or business. Therefore, we feel pretty strongly that that would qualify, and that the standard right now that people are using and that people are advising people on is that it needs to rise to the level of a trade or business. So that vacation rental you have up in Charlevoix probably won't qualify. As I mentioned before, under the specified service, the new regulations do appear to try to limit the scope of specified services, at least on that catch-all. Any business where the principal asset is basically the reputation or skill of one or more of its employees. The examples that get tossed around here is, generally speaking, again, using the restaurant or chef example, is that if you are a well-known chef, or take a celebrity chef, for example, and they have a restaurant, you're probably going to go to that restaurant because of who the celebrity chef is. The IRS has said that that individual, the restaurant itself, is not considered a specified service because they're actually there to provide food. However, if that same person were to endorse a product and any fees they got from that endorsement is based on the reputation or skill of the person. Therefore, that would not qualify for the deduction. So this could be looked at as a win for the taxpayer, because again, there was a lot of nervousness that this was going to kind of disqualify anybody in the service industry. They did go through and specifically mention various services. The first one was health. Basically, they need to provide medical services directly to the patient. So This does not include medical services fields that do not deal with patients' health, such as health clubs, spas, any type of payment processing, researching, testing or manufacturing, pharmaceuticals, or medical devices. So basically, we're looking at directly your doctors, your pharmacists, nurses, dentists, vets, physical therapists, psychologists. For attorneys, specifically using knowledge of the law as part of their services. Accounting, any type of accounting services, return preparation, financial auditors. I do know some accounting firms, such as our own, do a lot of technology stuff. The thought there is the technology piece actually would qualify, but obviously the accounting piece won't, which, as you can tell, can lead to some complexity in how things need to be accounted for. Performing arts. Any individual who participates in the creation of performing arts, such as actors, singers, musicians. This does not include services that do not require unique skill for creation of performing of arts, and it also does not include broadcasting. So the Disney Corporation, if they actually had some pass-through entity that does any type of broadcasting, would potentially qualify. Consulting is considered as specified services. It does not include services that is not considered advice or counsel, such as sales, training, or educational courses. So you can kind of tell, especially if you have some mixed services here, like an accounting or an attorney that provides a webinar like this one, technically speaking, wouldn't be considered a specified services. Athletes do not qualify. Other financial services, such as services provided by financial advisors or investment bankers, also does not qualify. Brokerage services, investing and investing management also does not qualify. The IRS also went through and specifically mentioned that if your gross receipts were under 25 million and less than 10% of your gross receipts are from a specified trade or service, then you are not considered a specified trade or service. If you're over 25 million, then that threshold is less than 5% of gross receipts. If less than 5% are from one of the above specified services, then the IRS would not consider your business a specified service trade or business. So the actual calculation, and as I mentioned before, I didn't get into a ton of detail or specific detail, but I did kind of want to walk through, at least briefly, how some of the overall mechanics work. So the first thing you have to ask yourself is what you're doing, is it a service business? If the answer is yes, then you have to look at what your taxable income threshold. If you're not over those thresholds mentioned before, the 315 or 157.5, depending on what your filing status is. If it's not over, then in general you could qualify for up to 20% of QBI. I say could because there's still taxable income limits where if it's too low, then your deduction gets limited on top of that just based on what your taxable income is. If it's over the threshold but not over the full phase-in or phase-out, depending on what you want to call it, then the deduction gets reduced. If you are over the full phase-in, the 415 or the 207.5, and you're a service business, then you don't get the deduction at all. So as you can see, there's potential here for some tax planning. It's going to be really, really important to get out in front of this to kind of see where taxable income is. If your 1040 income is already kind of close to those thresholds, it doesn't hurt to talk to see if there's anything you can do to get under, just to make sure you qualify for the deduction. This also does present the possibility that if you co-own a business, or if you have multiple shareholders or multiple partners, that you could in theory have one or two partners, depending on what their income is, that they might not qualify, but you do, so you can see that distributions can be greatly impacted. And yes, taxable income does include all your taxable income. So if you're married, it also includes any income that your spouse has, W-2. It includes just about everything on your 1040. If you are not a service business, and again, you are under the threshold, the calculation is fairly straightforward. It's 20% of your QBI, again, subject to what your taxable income actually is. If you are over the threshold, but not over the total phase-in, your deduction gets, I shouldn't say your deduction gets reduced, it's more that your deduction potentially could get limited based on other factors. And if you are over the full phase-in, your deduction is limited as well. So again, and it's probably better to say there on the second bullet point under no, is that your deduction is limited as opposed to that it's actually reduced. So you end up over the threshold in general, and this is where it starts to kind of get complex. If you're over the 415, okay, or that should be 207.5, the deduction is equal to the lower of these two bullet points, which is 20% of QBI, or the greater of the W-2 wage calculation that you can see here. So basically what that means is you figure out what 20% of QBI is, you take that number, and then you take your W-2 wages times 50%, and you take your W-2 wages times 25% plus 2.5% of your unadjusted basis of qualified fixed assets, which we'll get into what that means here in a minute. You take a look at those two numbers, pick the greater of those two numbers, and then you compare it to 20% of QBI, and whichever one of those two numbers is lower, that's your potential deduction. And again, if you have no overall taxable income on your 1040 or your taxable income is too low, then QBI deduction will be limited. So you can tell that this calculation can get complex, and it's also really important on wages, how you allocate wages. I know we have a lot of clients that use a common paymaster, very similar, or you pay wages out of one entity. That is perfectly okay. You can still do that, but the allocation, if you have multiple businesses, how you allocate those wages becomes very, very important, because each business is going to have its own calculation. Similar to the D-pad, how you're able to allocate wages across multiple entities, but then that's going to factor into these limits if you're over the taxable income threshold. So it's pretty important to take a look at that. If you don't do any wage allocation, then you can see very quickly that potentially for some businesses your deduction could be limited to zero. So the question you might need to ask yourself is, should I be allocating wages over multiple entities? If you only have one entity, then obviously that's less of an issue for you. You just can look at your W-2 wages for that one entity. You can also see very quickly for Schedule C's and E's why the wage issue is important. If you own your own business and you're the only employee and you're a Schedule C or Schedule E, you have no wages. So that number automatically becomes zero. Now you still do have the 2.5% unadjusted basis in fixed assets calc to go through, which could add a little bit of a deduction. But does this give you another reason to look to making S election or not? It's certainly worth potentially talking about. So what is QBI? So basically for any taxable year, you take the net amount of qualified items of income, gain, your deductions, and any losses with respect to any qualified trade or business. This trade or business does need to be in the U.S., so if you have any foreign activity, just like under the D-pad, if you were to take it, the foreign activity gets excluded. Basically, investment-related items are excluded. It's not exclusive to just these items, but these were kind of the common ones that I figured most people would be familiar with: interest, capital gains, and losses, dividends, non-business interest expense. Those items need to get pulled out in the calculation. I mentioned this just a couple slides ago. The fixed assets that you have do come into play. The unadjusted basis immediately after acquisition is what they're calling it, is basically any qualified property held for the use of a trade or business. This means it has to be tangible, it has to be depreciable, so land does not count. It has to be available for use in a trade or business at year end. It has to be used in the production of your QBI, meaning it has to be placed in service. Any property qualifying, there's two life dates that they use. It's the shorter of 10 years after the place in service date. So basically, any asset that you have that has a useful life of under 10 years, you're going to use 10 years. Or it's the last day of the actual depreciable life. So if you have any asset that's over 10 years, you're going to take the depreciable life of that asset. So land improvements would be 15 years. Building would be either 27.5 or 39, depending on what the useful life is. So basically, you get to take the original costs of all that property, and that qualifies, you multiply it by 2.5%, and that's the number that you use for the purposes of the 199A limits. So it might give you a bit of an incentive to actually purchase, make a big fixed asset purchase that you've been waiting on. Partnership basis adjustments, if you own a partnership, so things like Section 754 does not qualify. 754 is not a tangible asset, even though it does get assigned to tangible assets. And improvements to qualified property is generally treated as separate qualified property with its own place in service date, so that if you improve something, let's say a roof on a building, but you don't actually get rid of the building, then the improvement is going to have its own placed in service date. It doesn't revert back to the original building date. Or if there's another fixed asset that you have that you've improved without disposing, it doesn't necessarily, that improvement gets a new life. The old asset still remains with its original life. The IRS and the regulations did recognize that there might be a little gamemanship here on the part of taxpayers. So they did add a little caveat that property acquired within 60 days of year end, that is also disposed of after 120 days. It needs to be used in a trade or business for at least 45 days. So basically, the IRS has said you can't just buy property at the end of the year to increase your deduction and then get rid of the property right after year end or very quickly, never use it. They're not going to allow that. Otherwise, you're going to have to find a way to prove that it wasn't just used to increase your 199A deduction, which I imagine is going to be pretty hard outside of, we bought the asset, we thought we were going to use it, we were in the process of placing it in service. We placed it in service for a couple of days, and then all of a sudden we decided that something better came along, so we got rid of it shortly thereafter. So basically, the IRS is aware that there could be some games going on at the end of the year. Like-kind exchanges or involuntary conversions is treated like replacement property. The place in service date is considered the date of the relinquished property was placed in service. And any excess basis that gets added in the replacement property is the place in service date that the individual or pass-through places it in service. So basically, if you have any carryover basis, it stays with the original place in service date. Any additional basis gets a new place in service date. Now, this is not going to be a big of an issue starting in 2018 because like-kind exchanges no longer exist for personal property. So your equipment can't have a like-kind exchange starting in 2018. However, any old like-kind exchanges, the original carryover basis does need to be tracked separately from the additional excess basis that gets added onto the new property, and you can still have like-kind exchanges in real estate as well to look at. How is this all going to be reported? Very similar to the DPAD. The pass-through entities are going to have to gather up all the information and report the deduction on Schedule K1. This is going to include your share of QBI, W-2 wages, any UBIA, which is the fixed assets, and if there are any specified services, trade, or business determinations. So the business entity is going to have to do the reporting so that you as an individual on your 1040 can actually claim the deduction. So again, the business doesn't claim it, it just reports what's out there, and then you on your individual 1040 or will claim the deduction. It is done on a business by business basis. That does not necessarily read as an entity by entity basis. So if you have one entity that does multiple things, you will need to potentially look at separating out whether that's on an income statement. If you do a lot of billing, your billing might need to be broken out into specific things that you're doing, so that way you can go back and actually pull out what business activities you're doing, what may qualify, what may not qualify. There are active and passive rules considerations that need to be looked into, more so on the calculation side. Kind of like, what if one entity has a passive loss, the other one has active income? How is that going to affect the deduction? Another big thing that came out in the regulation was dealing with self-rental property. So if you're a business that has, whether it's real estate, whether it's equipment rental, that it rents back to the business, if your self-rental is of a specified service, so if you're an attorney or a doctor that rents your own building, whether you own the building personally or it's in a partnership, that self-rental will not qualify as QBI. Basically, the IRS doesn't want playing games, as some people were looking at potentially increasing rent from your service business, effectively shifting it over into the rental, therefore getting the deduction on the rental property. The IRS has said that will not be permitted. Another thing that I don't have mentioned here that was kind of glossed over early on is that it's any activity done as an employee does not qualify, so that some people were actually considering basically becoming a contractor instead of an employee. Well, the IRS has said that if you do that and you're really technically an employee, they're still going to disallow the deduction, so that if you're a doctor or an attorney and we're not worried about the income thresholds, and you work for a firm and then all of a sudden you decide, well, I'm just going to switch myself to be a contractor, which may or may not be permissible on its own, the IRS has said, well, even if that's all you do and you're still working for that one firm, then you're basically just an employee. What you've done is tried to basically take advantage of a deduction that you're not going to be entitled to. Therefore, that 1099 income won't be allowed, which doesn't really come as a surprise to us that the IRS has said that. The other big thing is reasonable compensation. Now, this has always been an issue, especially dealing with SCorps and a little bit in CCorps. But as far as pass-through goes, reasonable compensation, the IRS has said they are very aware that this is an issue and they will be looking into it. So it's going to be extremely important to document pay and why, especially if it changes, on how you came up with the amount in that tax year. To me, this is a facts and circumstances thing. I could very easily see an argument that if your income is down in the business, you want to, you hypothetically say in 17 you paid yourself $1 million because you had a great year, but now you're paying yourself $150,000 because you had a terrible year. I would not be surprised to see the IRS come try to challenge this, but if you have an important, if you have a good reason onto why, such as we didn't make as much money in 2018, I didn't want to drain the company of cash, or we were doing some big capital investments or whatnot, then there could be very good valid reasons. And I think it's going to be very important to look at what your compensation is. The other thing is, no matter what you pay yourself, the IRS could, in theory, come in on an audit and adjust or claim that your reasonable compensation should actually be this, so that, say you only pay yourself $150,000, so that you've increased you decreased your expense in the business, therefore you increased your deduction. The IRS could come in and say, no, your actual reasonable comp should be $300,000. We're not going to tag you for that on your W-2, but we are going to adjust your QBI. So even though you only paid yourself $150,000, you should have paid yourself $300,000. Therefore, we're going to lower your QBI deduction based on that amount. And in theory, I guess the opposite could be true too. If you pay yourself $500,000 and the IRS comes in and says, no, you really should have paid yourself $200,000, they could adjust it that way. I just don't see that being as big of an issue since most people aren't going to try to lower their deduction through wages. So documentation is going to be important, and especially if it fluctuates a lot. The other thing that you're going to be permitted to do under 199A, and this is an election, is you're able to aggregate all of your businesses into one. I don't know if this is good news or bad news, but the news is once you do that, though, you cannot change it. So that if you have 3 entities and you elect to do an aggregation of the businesses, you can't do it in 18 and then not in 19. You have to keep those businesses aggregated until you sell one of them, and then obviously it goes away, but the other two businesses would still need to be aggregated. If you also add additional businesses after that point, those can stand on their own, or they could be aggregated with your old ones, or any new businesses could be aggregated with any new businesses. So you do have some flexibility on any new entities that you might create, but the old ones gotta stay together. Some other issues related to 199A is if QBI is a loss, it does carry forward to the next year. Losses will lower your QBI deduction, so that if you have one business that makes $100,000, another that loses 50, each of those entities, assuming no other limitations apply, each of those entities would come up with their own calculation, with their own QBI, and you will combine them. On the surface, this does actually make some sense, because if your 1040 only shows $50,000 of income, it wouldn't necessarily make sense to take 20% of the 100,000 or 20,000, take the full deduction, since your actual taxable income from the business entities is only 50. However, I did think of one potential issue with this is that if you are active in all your entities and you have no basis concerns, you could, in theory, take a loss on the tax return. So say that your total business taxable income from the pass-throughs is negative. You could, in theory, take a loss on your 2018 tax return, but that QBI deduction is going to, or the QBI loss is going to carry forward, which if you have taxable income in 2019, well, now you've already deducted the loss in 18, but now your QBI deduction is still going to get limited in 19, or at least lowered. So that is just something to be aware of, not that there's necessarily anything you can do once the loss gets created. It's just could be one of those things that it is what it is, but with some tax planning, maybe it makes sense that doing something like being aggressive on depreciation, not taking bonus, could potentially be something to look at. So it's just kind of one of those things to be aware of. There are also additional active loss rules that now apply to 1040s. Any of you that have passive businesses are probably somewhat familiar with passive loss rules, that when you have a loss in a passive activity, it gets limited and it carries forward until you have passive income. There is actually an additional layer for your active businesses, that there is a cap. I believe it is, I don't have the exact number in front of me, I believe it's somewhere around $500,000, and that's a total active loss if I remember correctly. It's not an individual entity by entity basis, but we will have more information on this on one of our other webinars that we'll do. And there's also NOL limitations, that basically you cannot carry back a 2018 NOL anymore. 2017 you can, but 2018 you cannot. It'll carry forward. And that was done to help simplify the process. So, kind of bring this back around full circle. You're sitting here with an SCorp, a CCorp, whatever, a single member LLC, a partnership. What should I do? Should I stay should I stay with what I got? Should I look at going into something else? Well, like everything in the tax world, the great answer there is that it depends. Biggest thing that I usually look at is what's happening to your earnings. If you're always taking it out, a C-Corp to me does not make any sense. You still have that second layer of taxation with C-Corps. That did not go away. You're still going to be tagged with a dividend or a wage, depending on how you try to take it out, and you're going to lose any benefit the 21% has, because now you're introducing at least a 15% capital gain, which automatically puts your federal rate at 36%. And your max individual rate is 37. So it's to me, that's a break even. And then when you add the state income tax rate, the corporate rate actually goes above the individual rate by about a percentage point. And if you are exposed to the net investment income tax or the higher capital gain rate at 20%, now your 20 plus 21 is 41, and that's already over the 37% rate, no matter how the state or the net investment income tax impacts you. So now you might be thinking, well, does it ever make sense to be a C Corp? Well, it still could. Again, it kind of depends on what you want to do with your earnings. If you can keep the earnings inside the corporation, allow it to grow, you can at least year to year, you'll get the benefit of the 21% rate, so that you have more income growing inside the C corporation. Another thing to potentially think of, though, is long term. Don't look at this as just a short term thing, because at some point, assuming that we all want to retire at some point, and you want access to that money, you got to pull it out. Well, the second you pull it out, you're going to get tagged with whatever the capital gain rates are at the time, if there are any, whatever the individual tax law might be at that time. Something else to keep in mind is that the 199a deduction is set to expire. That was not a permanent change. It is set to expire at the end of 2025. Obviously, when we cross that point, I'm sure Congress will be fighting over whether or not to extend it. The 21% corporate rate, it does not expire. There was no sunset provision in the tax law. However, like with any tax law, it's subject to change depending on the mood of Congress at the time, or who's in the White House. So you do need to consider, what will the law look like down the road, which obviously can be hard to predict. So I guess the best thing I can say is really look at this from a long-term perspective in addition to a short-term perspective. I know a lot of people saw 21% versus 37% and it made a lot of sense, but when we dug into it a little deeper, we found that at least in the cases that we looked at, that it didn't make a lot of sense just because of what was going on with the cash flow. The other thing, again, is to think about is just basically what are you going to do with the cash, with the business, whether it's now, next year, 5 years from now, 10 years from now. At some point, the money's got to come out. And it's not a tax-free transaction. At least right now, it's not a tax-free transaction to pull that money out of a C corporation. Pass-through entities. As already mentioned, its big thing is to look at your compensation. Doesn't make sense to pay that big bonus at the end of the year to cover federal tax withholdings, or could you potentially get under the thresholds to get the full 199a deduction by switching your compensation to distributions, pay the taxes through distributions. Now again, there needs to be a defensible position that you're not just trying to create a deduction and that your wages are reasonable, but it is something to potentially consider, to potentially look at. For Schedule C's and Schedule E's, does it make sense to stay as Schedule C or a Schedule E? Does it make sense to look at, for a Schedule C, if you want to pay yourself a wage to potentially increase your QBI because you don't have any employees, then it doesn't make sense to make an S election. So therefore, you're allowed to pay yourself a wage and increase a QBI deduction. If you're going to be under the filing threshold, though, keep in mind, again, there are no limits. It's 20% of QBI, regardless of whether you're a service industry or not. So the biggest thing is taking a look at, talking to your tax advisor, talking to the person that's in charge of your account, and just getting in front of this and walking through it, because this isn't a simple yes or no answer. I mean, there's a lot to consider. The other thing to consider with entity structure is obviously the legal side of it. So, talking to attorneys is going to be important, making sure they're in the loop on what you're trying to do. So, basically, the tax law shouldn't be the only reason why you do something. Obviously, it can be a factor because there is a potential for some planning opportunity here, but it's not the only thing to consider. I did want to mention that our Solutions Conference at the Lansing Center downtown is November 28th. You can sign up at MaynardSolutions.com at that web address there, or email events@MaynardCPA.com. There's going to be 5 separate educational tracks with various topics that you see listed there. I know if you've enjoyed listening to me talk that I'll be there too during tax reform. And then we do have some upcoming webinars on October 9th. During lunch, we'll be talking about a little bit more in depth about the business tax changes. There'll be a brief overview of 199A there. There won't be an in-depth discussion because we're going to hit as many of the business tax changes as we possibly can. And then on October 30th, we'll talk about some of the individual and state tax impacts that exist, especially some of the unintended consequences of the federal tax bill, which I know at least on the state side they're trying to fix. So get those events on the calendar, and we hope to see you there. And in case of the webinar, hope you decide to join us. Feel free to send me any questions that you might have there. Like I said, if you want to see specific examples, I'll be happy to scan those over to you so you can see the fun little math problems that they provided. So that's it. I want to thank you for joining me today. Hopefully this was helpful, and hopefully we'll see you again at either the Solutions Conference or one of the future webinars. Thank you.